Hello, we meet again. Today we'll be discussing macroeconomics, McConnell, Brew, and Flynn, Chapter 7, Measuring Domestic Output and National Income. What we'll be trying to do is calculate a country's output and income for a year. These are important figures to discuss as well as the different ways that it is measured. Then we'll adjust those figures and calculate for inflation, do a little analytical work, briefly talk about the last word of the chapter, difficulties in measuring GDP, and inflation in the digital age. As always, this is not a substitute for you reading the textbook. It's not a substitute for a lecture. This is meant to be a complement or a supplement to what you are already doing. Please do any practice work involved. Or if you're just someone who likes econ and you just wanted to check this out, I appreciate it. In that case, do all that other stuff, share, like, etc. Any comments, always welcome your 2 cents to the discussion. All right, then. With that underway, we will get going. For those new to how I normally do these things, I'll be also mentioning the page in the textbook and the slides along the way. Chapter, we're going to talk about measuring the economic performance of a country, the expenditure and approach models, other national accounts, nominal versus real GDP, and any shortcomings in the gross domestic product or GDP. Now, we mentioned that a couple of times, but the national income accounting measures the overall performance of an economy of a particular country. Now, you need some type of scorecard, you need some kind of grade book, you need some type of measurement to tell you how a country's economy is doing, pretty much how well it handles services and goods, if it's growing, if it's shrinking, if it's static. The reason that you're looking for this information is so you can figure out what to do. If the economy is healthy, how do you keep it going? If it's not, what changes need to be made? But you need some type of measuring system to first get to it in order to figure out whether or not it is healthy or it needs some work. And this is the purpose of measuring GDP, and we'll define that in a minute. There are a couple of ways that you do it in the United States. The Bureau of Economic Analysis compiles a lot of information about income and the production of goods. You're again trying to understand how the economy is actually doing. So we're on page 130 moving forward. Gross domestic product or GDP, what we'll be calling it from here on out. What is that? Everything that is made. So, oh, I forgot to mention, grab yourself a cup of coffee or tea. We're going with coffee today. Everything that is being measured or mentioned, everything that is being produced, from the paperclip all the way to a building, everything that is actually produced as far as GDP counts as GDP. So if there are 5 widgets, they're $10 each. That's all you sell. It's $50 worth of GDP. Now, when we're doing this, we're counting only finished goods. Stuff that's not going to be added to some other product, nothing that is going to be used in any other fashion. It is to the consumer, and that is it. If you were looking online on YouTube, you'll find a couple of videos talking about the difference of a finished good and a good that is used to make another product. The distinction is this. If a bakery buys flour, eggs, and milk, it is not a finished product. It is going to be used to make a final good. In this instance, say a cake. Once the cake is made and sold, now it's a finished good. If you, the consumer, buys flour, milk, eggs, butter, it is a finished good because it's not going to be used to be sold for anything else. And there's the distinction. Now, the reason that we do this is to avoid multiple countings. In the scenario about, again, the flour, butter, eggs, milk, you don't want to keep counting over and over again. And we'll get into an example of that in a few slides. So you avoid counting it multiple times. You only want to count it when it's being used by the consumer. You don't want to count intermediate goods. In this case, a bag of flour would be an intermediate good. What you're counting also is the value added. What do we mean by value added? What we're referring to is the fact that when you buy a product, you're paying because someone prepared it for consumption one way or another. If you're driving down a road and there's a young girl selling apples at a stand, maybe she's near a farm, family farm, okay, there wasn't a lot of preparation. You're just getting apples she probably picked off of trees. You go to a grocery store like Walmart, for example, there's a bag of apples. Someone went through the effort of gathering the apples, putting them in one nice little package and making it easy for you to consume. There's the value added. And it's also for domestic consumption alone. Meaning, if you are, your textbook gives a pretty good example, a factory in Ohio. It's a Toyota factory, which is a Japanese automobile manufacturer. It counts as domestic GDP, which is where you get the D from, because it's made inside of the borders of the United States. Now, if General Motors has a factory in Canada, it does not count as gross domestic product. It counts as gross national product, which is a system we don't use anymore. Gross national product is anything, anywhere, as long as it is a domestic company. That was the measurement for some time ago, but they switched over to the other one. Okay? Had to set that up so we're all on the same page. Moving on to slide 5 on the bottom of page 131. You're counting the value add and the different items that are being sold. What you'll notice is that you still have 5 items being sold, but it's just a question of how the mix changes. So from one year or the other, it's still 5 items. It's just a question which one is being sold more often. All right, a moment ago we talked about value added. Here we have a sweater being sold, or coat. First, you're going to need the raw materials. Let's say it is a cotton sweater or coat. Well, you're going to have to go get, we're doing sheep on this one. Wool coat. You're going to have to get the wool from somewhere. Little elves are not going to drop it off at your doorstep. You're going to have to raise the sheep. Well, this is what the farmer's charging before the sheep are sheared. Then you're going to have to take the wool and get it processed somewhere. That manufacturer will sell that to a coat manufacturer who now has the wool that has been processed. If you've ever seen sheep, you're not going to do too much the way it is set up. Got to do some work on it. Then it's put into a wholesaler, then the retailer. We're going back to our default of Walmart. If you counted the value added at each stage, you see the value total will be over $1,000 compared to what Walmart may just sell the coat for, or Amazon, $350. You avoid counting everybody along the way. It just makes the math simpler as well. Things that do not count, non-productive transactions, are excluded since it has nothing to do with the production of a final good. There are basically 2 types. Purely financial actions such as transfer of funds. That would be Social Security, disability benefits, and things like that. Private transfers. Okay, we are good friends. I have tons of money. I decide to give you $1,000 at Christmas. You didn't do any work. I'm just feeling very charitable. It is a private transfer of money. It doesn't count at all. It's not going to count until you actually spend it. The last one that we're going to talk about here are just financial transactions. We're on page 133. That is when you're buying stocks, bonds, mutual funds, and things of that nature. Nothing is recorded as GDP because you didn't buy it. There's nothing that you purchased. No consumption. When we look at the last point on this slide, if it's already been counted, you cannot count it again. I'm looking for another guitar. You happen to have a spare you're not using. You decide to sell it to me. The guitar was counted as GDP when you bought it. We do not count it a second time. So keep that in mind when you're doing all those calculations. And if you have a spare guitar you're willing to donate, I'll leave my information where you can ship it to. There are two ways of looking at GDP. The numbers should be about the same. One is the expenditures. And that gets into another term, PCE, production, consumer expenditures, and things of that nature. Stuff that we all buy. Flour, milk, soap, toothpaste, etc. You earn a living, you spend the money somewhere. So everything that is made is counted. So it does in line or align with the next portion is income. You make a living, you're going to spend it somewhere. It has to go somewhere, and it should line up close to about the same point. So you make money, you spend money. This is how you track GDP. In the income approach, which is not used as much, but it's still there as a tool, you're looking at things like wages. You have property, you get income. You have income from investments. You have profits from a business that you are running. Either you own the whole thing or maybe you're doing a little work on the side. So either way, every time a dollar is created in some form or another, you're trying to track where it is. That is GDP. If we're looking at this from an accounting standpoint, we're going to get into what these are in a moment. As we discussed already, the expenditure model or the output model is usually the one that is used in most economic discussions. The input model or income model is probably a little better, is the other one where we're discussing wages, rents, and etc. So let's get around to the expenditure model. We're on slide 10. U.S. uses the expenditure model. We're looking at 2021. First part about that from the other slide. And let's flip the page. We're on page 134. You're looking at the letters. And you have to remember that because it's probably going to be on your quiz or an exam. CIGX. Personal consumption expenditures. Again, that's where the PCE is coming from. Investments, that's into private business. Government expenditures, this is where you get your G. Net exports. That means everything that is sold outside of the country, everything that is purchased, brought into the country. The difference between the two is the net exports. Total that up, you get GDP of pretty much $23 trillion. And as of the time of this recording, only the U.S. and China are among the countries that have over $1 trillion of net GDP, I believe. Looking at it from our income allocations, you'll notice the largest contributor happens to be compensation. People who are working for someone else, employees, rental, interest, property income, even corporate profits, you'll notice most of it comes from there. You take the difference as far as net income, consumption of fixed capital, that is depreciation. You get to write off the fact that the factory, you get to depreciate the building, the equipment, trucks, everything else. So that comes out. It's being partially used and has to be replaced. Now you'll notice that there's a little bit of a difference between the two as far as output and income. There'll probably be a little bit of a difference. That is a big number in and of itself. It's a noticeable number. It is probably larger than some GDPs of smaller countries. However, we all know it's not going to line up perfectly as an economist, so we understand it'll be a little bit off. Money that's slipping through the cracks that is not reported. We'll get to that towards the end as far as unreported GDP. In the expenditure models, again, we're going to start with personal consumption expenditures, goods and or services. The first thing that we talk about here, we're still on page 134, slide 12. Expenditures come in three flavors: durable, non-durable, and expenditures of services. Durable goods usually last 3 years or longer. Non-durable are things that are consumed and they don't last 3 years. A durable good is a washing machine, a dryer, refrigerator. A non-durable good is ice cream. You go to the movies. You're not storing anything that you watch at the movies. It's immediately consumed. Services, which are now moving on to being the largest portion of the expenditure model. Haircuts. Watching the movies, again, is more of a service than a non-durable good. Again, wherever you get your nails done, pedicure, manicure. We all need a good manicure and a pedicure every once in a while. And if you're looking at a percentage, just so you know, 10% goes to durable goods, 30% to non-durable goods. Ice cream, food, gasoline, etc. 60% now is service. Think about all those streaming subscriptions that you have. You have to have an internet provider. You have to have a cell phone provider. Nothing that you can tangibly hold, but those are services, and this is where most of the money goes. The I, investments, or I like to call it industry or an institution. This includes everything used to make the final goods, back to machinery, factories, tractors, warehouses. Residential construction, R&D. If you are a musician, you are an artist, those things as well. And changes in inventory, meaning you started off with $10 million of inventory, but at the beginning of the next year, now you have 12. That means you have a surplus. If it's 9, that means you sold more than you had at the beginning of the year. The creation of capital assets and our financial transactions are excluded. Again, stocks, bonds, etc., etc. Your textbook uses a really lovely analogy. One are called tools for consumption. The other is called receipts. Love this. You're in construction, you need tools, hammer, nail, etc. If you are in the intangible areas, it's the recipe for the cake. Grandma's secret recipe, you've turned that into a multi-million-dollar business. Outstanding. Please feel free to send me a few samples of the cookies, though. Chocolate chip, but I'll accept oatmeal just in case. Once all that's done, we've covered the initial part as far as a business and how it's run. Slide 14. As we were talking, how much you started with the beginning of the year, net investments, depreciation. Again, you have to replace things when they break or getting old. Computer has a lifespan of about 5 years. It may still work, but you're looking at probably getting an upgrade, especially if you are working in an office environment. Year's GDP changes, consumption, government expenditures, exports, and so forth and so on. Now we're back to the stock and how it's changed from year over year. The last two, slide 15. Government expenditures, goods and services. Typically, governments don't make a lot of things. They purchase them. Maybe they add to them later on. Publicly owned capital, national parks, state parks, and things of that nature. Government does get into R&D. They have areas where they're doing research for other things. That might be for vaccines. That might be for, I don't know, the latest hardware, things of that nature. It excludes transfers of payments. What do we mean by that? That is when we no longer, well, we don't count things as Social Security. You put into it, you get it back out later on. You don't count it because it's not money that has been spent. Hopefully you're doing very well investing. You collect the Social Security, you don't need it, you just leave it in the bank. It doesn't count as GDP because it is not purchased, not used to purchase anything. And net exports. This is how you figure that out. You add into the economy anything you export, you subtract anything you import in. Look at it from the standpoint of a flow of money. If you are selling goods to Canada and Mexico, they get the goods, you get the money. If you are buying, however, French wine or champagne or things of that nature, cheese, whatever it may be, that is money going out, but you get the goods. And those are durable, non-durable goods. The wine, the cheese, the champagne, it'll be consumed. Usually within a short period of time. And I know some of you are going, well, I have the wine I'm going to store. Yeah. That's not what we're normally going towards. Okay, there are exceptions to every rule. Globally, in trillions of dollars, as you'll notice, again, stand corrected, apologize, thinking of the bigger players as far as trillion-dollar countries. There is only two that are double digits in the trillions of dollars. Japan, Germany, UK coming in, bringing in the rear, and you see it just kind of shrinks after those bigger players. The income approach. Compensation from employees, money you get from rentals, profitable businesses, things of that nature. Everything you make usually has to go somewhere. Now you're going to have to buy food, pay the electric bill, pay the water bill, etc. So money is going to go out for that. This is how it tends to line up. And you'll notice that discrepancy. If you're buying investments, it's not going to track as well, which is where you get the discrepancy. But if you're counting all the money you're making and you don't spend it, this is why it tends to be a little higher on the income approach rather than the output. And you also have to include our good old friend taxes. Gotta pay those, gotta pay those. National income from GDP. We're on slide 18, we're on page 139. Under this approach, all expenditures and services flow either to private citizens or the government. The national income to GDP, several adjustments need to be made. The first adjustment is the foreign income. If you are close to a foreign country or you do a lot of traveling internationally for your country, that income needs to be adjusted. It taken out, and then the income the people living in those countries gain from the supplemental resources to the U.S. would be added. You also make adjustments for the private use of private capital and equipments that extend beyond the year upon which it is produced, meaning the tractors, the trucks, the warehouses, and things of that nature. The cost of the usefulness will slowly decrease, and at that point, you start to depreciate, and this is where you get the idea of that balance sheet from the other slide. You're replacing things, things are depreciating, so you have to take that into account. I'm sure your accounting majors are having loads of fun. Other national accounts, and we're going to get into a little of accounting for the next couple of slides. Net domestic production, net income, personal income, and disposable income. This one's going to go from page 140 to 142. And domestic income is GDP. We take away or subtract fixed capital depreciation. You need a truck for your business. The truck's lifespan, I think accounting is about 5 years, no more than 7. And each year you depreciate a little bit of the value of the truck because you're going to have to replace it. I had a student who ran their own lawn service business. He told me that the riding lawnmowers last maybe a year. My favorite and best examples of why you have to depreciate that and why it comes out, because you have to replace it the next year to average out what the GDP would be for that. Your national income. This is where we take out the discrepancy, the net foreign income factors, income from U.S. citizens living overseas or working overseas, coming back home, and things of that nature. We'll subtract that. What's left is our personal income. Then we start to take in and out taxes for imports, corporate taxes, Social Security contributions, undistributed corporate profits, transfer payments. Now we're left down to the PI. After all of that, we're getting close to our disposable income. After we have the PI, the personal income, we take out personal taxes. That is our disposable income. After Uncle Sam gets his fair share, that's what we're left with, and this is what it looks like. Now, those who are really into econ, you can go ahead and put a spreadsheet together, putting in the numbers, you're going to get the calculations. The flow of how this works. I am not going to go into the circular flow model. But if you're looking at it, you'll look at the income starts us off towards the middle of the flow chart. Then you have net domestic production, national income, things coming out of there, Social Security and so forth and so on. Your personal income, I'm moving left to right. Disposable income, household expenditures, and they back to personal consumption expenditures and personal savings. We're on the bottom of the graph, flowing back up. The businesses take the money. This is back to GDP. As you can see, everything we've talked about is a nice closed-in loop. The one on the top, the foreign exchange, that comes into play as well. But the money just simply has to circulate, and it brings in mind a very good concept. It occurred to me when I first studied this. You need the money to circulate in order for everyone to benefit. It has to do something. Putting the money under your mattress, burying it in a coffee can in your backyard is not helpful. If the bank has it, they loan it out and it becomes productive. Now, nominal and real GDP. And we're on page 144. Nominal GDP, quite simply, is where it is today. Whatever the day is, that's what is considered as nominal GDP. Real GDP takes into account inflation, or the cost of a good changing over a period of time. It's maybe the same good, but maybe it's going up every year in a cost due to a change in the cost of everything needed to produce the good. How do you figure these things out? First thing you need to do is have a starting point. That becomes your price index. The index is whatever year you want to start that becomes your base year, 2000, 2010, if you want to pick a nice even year. You get a basket of goods. Someone takes a shopping list, they go to Walmart. You send grandma out to go, again, get the eggs, the butter, the milk, the flour. And you put that cost and the numerator and the denominator. That's where your initial figure becomes real. The next year, you send grandma out with the same shopping list. What you'll find is if there's a difference in the nominal or a numerator in this particular instance, this is where you're going to find out, and that's your real GDP. So if we're using 100 over 100, and next year it's 102 over 100, inflation is 2%. You want to take that into account. Let's say you're running a business and you sold $100 million worth of goods. Next year, you sold $102 million worth of goods. Well, you're saying, okay, well, the profit went up. If the cost of the goods also went up by 2%, the net effect is you're about even. This is why you need to concern yourself with inflation. Real GDP versus nominal. And this is a good illustration of it. You see the output in the number of pizzas, and apparently pizza production is expensive, from $10 to $20, $25, $30, and then it fell down a little bit. Okay, slide 25. Steps for deriving real GDP from nominal GDP. We went through that a minute ago. So you're either looking for that to compute the GDP or you're looking for the quantity sold. Not going to get into that. I think you can handle that one, read that one, since we discussed it briefly a minute ago. Indexes, price index. I need more coffee. Nominal, real GDP price index for the U.S. based on a couple of different years. Okay, swig of coffee, I'm good. The base year, as you can see, 2012. You can go back and figure out how much the cost of goods were lower in prior years and how they've changed since then, measuring inflation. So from 2012 to 2020, it's gone up about 13%. Now, are there any problems with GDP? There are some shortcomings, and we're on slide 27, page 147. It does not include non-market activities. If you do your own home repair, you're actually saving money, which is why people tend to do that. However, you're not spending money on GDP. So there's a worker who isn't being compensated. But productivity has happened. Leisure and psych income. Just by having a good time. You could be earning a living, or you could be just sitting at home on the weekend, watching TV. There's a price for that. Your mental health is increased. you're good. You're not stressed, you're not burning out. So it's actually considered revenue in some sense or some type of gain. It may not be directly monetary, but it is a gain. Improving the quality of a product. You look at your cell phone, go look at how it was. Those who have a little bit of maturity on them, remember the first phones, all they were phones. They did not have the ability for you to take pictures in 18 different directions. You couldn't figure out where your location was. You couldn't figure out the location of the star system with it. Yeah, you're walking around with a handheld computer, a la Star Trek. GDP and the environment. Anytime you make something that possibly is an economic environment question that has to be paid for now or later, the composition and distribution of it. Earlier in the lecture, we talked about how much money or what percentage of personal consumption expenditure is durable, non-durable, and services. So where the money is actually being spent or created is important too. Because if you're going to figure out how to keep the economy moving as an economist, you need to figure out where it's being currently spent. Non-economic resources of well-being, that still falls in a little bit as far as just mental health. Maybe you're volunteering and that's important to you. Well, if you're volunteering at, say, a food shelter and you're distributing food to low-income individuals, that charity doesn't have to hire anybody. That is money that they save. So there is an economic component to it. And I have not overshot the underground economy. Just saving that one for last. Here's what happens with that one. By default, when we talk about the underground economy, a lot of people thinking of criminal activity, drugs and whatnot. Okay, that's true. It also includes legal activities. Let's say you're very good with your hands and you repair minor home issues, replacing a door and things of that whatnot. You do something with plumbing and so forth. You're good with your hands and you repair cars in your backyard, so forth and so on. You're not doing anything illegal. The question is, are you reporting all that income? If you are one of those individuals who have enough equipment in your backyard, in your garage to take an engine out, and you enjoy that and you do that on the weekends, are you reporting all that income to the IRS? You're supposed to shake your head and say, of course I am, every bit of it. I'm sure you are. I'm also sure there are a few people who are not recording that or reporting that income. So this is what you think about as far as the underground economy. It doesn't include bartering. I'm a good accountant and I do the accounting work for you. You're a good mechanic, so you work on my car. We're bartering. We both get what we want. Are we both going to report this as income to the IRS? I'm sure we both are, so you're shaking your head yes. I can see you doing that. There are a few people who probably won't be, but I'm sure you and I will. Underground economy, based on different nations. As a percentage of GDP, the ones on the top, you see a lot of GDP slipping through the cracks. That is not helping the nation as a whole. If nothing else, that is taxable income that those nations should use. Now, we do talk about gross output. This refers to everything that is made. And if you remember, we discussed GDP, it only includes the final output. Something that's not going to be used again in the production of something else, just consumers purchased. Gross output has every step of production that we were referring to. The prior slide talking about the wool sweater, if you remember that, that was over $1,100. The gross output, that is what you're looking at. You keep that information just because you're trying to figure out what's going on. You want to have all the information. You can decide what you do and do not want to use, but it's just an idea to figure out how much production is in the system. Last but not least, our last word. It is difficult to measure these things in the digital age because how much money is it worth, especially if you have things that are free? YouTube, free. Google, free. AI, free. But yet they're making money. What are they really worth? Yes, it's through advertisers. But how do you actually put a price tag on some of that? What is it really worth? Because if you're talking about the company, part of its value is its name and other assets. So how do you calculate that? Just a hypothetical question. That's the last word. Again, you can read that in your textbook all the way on page 149. Okay, not a long chapter, but it has some really good information, which is why it took us a little longer than our normal 25-minute or so lecture. All right then. Hopefully you enjoyed it. Again, like, share, enjoy. Go study, and I will see you in the next one.